You're going to get a mortgage. Should you put more down or less down? Today, we're going to give you the answer to that question.
You better get fired up.
All right, whether you're watching on YouTube or Facebook, feel free to put any comments throughout this video in the comments section, and we will absolutely answer your questions. Nate, my man, how you doing?
I'm great. I'm excited. I'm fired up. Let's go.
That's what I'm talking about, baby. You're speaking my language. I love that. In fact, I love it so much. I've got a fancy little, let's see if I can, how do I do it? Look at that. The Nate Jomaa Mortgage Team hat.
Yeah, that's a pretty epic hat.
Yes. Got to show my school pride there. So here we go. So let's talk a little bit about it. I'm a buyer, and I think, one of the, I don't want to say misconceptions, but things going around is if I put more down, the seller's going to be happier with me. The listing agent's going to be happier with me. My agent's going to be happier with me. That lender's going to be happier with me. And there are certainly reasons you would want to put more down, right? But there are also reasons you wouldn't want to put more down. And a lot of times this is why I recommend people talk with a lender maybe a month, 2 months, 3 months before they're even going to start looking. It's because that conversation is going to help a guy like Nate in a lending position structure how it is you're going to set up the financing. And once you structure it, it's going to impact the homes you look at. It's going to impact the discussions you're having with your realtor. It's going to impact a lot of those different things. So Nate, I would love for you to share with us some of the different things we might want to consider that would maybe nudge us towards putting less money down.
Sure. There's a lot of different reasons, but I'll look at two of them with you real quick. The first one, when you're putting 20% down on a house, let's say it's a $400,000 property, 20% of that's going to be an $80,000 down payment. That's a lot of money. Some people have 80,000, some don't. Let's say that you're somebody that has it, but it's a lot of money to you that you've got stored up and you've been saving it. You might want to look at putting less down. Let's say you put down 40,000, okay? That frees up $40,000 for you to be able to do things to that house. Maybe you want to do new flooring. Maybe you want to update the kitchen. Maybe you want to knock down a wall and make a kitchen bigger or make a bedroom bigger. That gives you cash to be able to make that home more of a home to you. It also gives you the opportunity to look at ways that you can use that money to increase the equity in that house. I mean, these things I talked about, these projects, that'll do it too. But maybe you want to put up a fence. Maybe you want to put in a pool. $40,000 towards a pool it could be in some cases a 50% down payment on a pool. There's a lot of reasons why you might want to look at keeping some of that money to you.
Go ahead. I'm sorry.
Well, we can dive into this one a little bit more because it's a hot topic, especially what's going on right now. But one of the other reasons is there's actually mortgage related factors that favor you putting less than 20% down. And we can definitely dive into that. I don't want to ramble right now, but what was your question?
No, and I do want to get into that because I know what you're going to touch on. And right now, in my opinion, it's the hottest topic in real estate. But before we do, I'd mention first-time homebuyers too. And it doesn't have to be a first-time homebuyer, but anybody who is tighter on funds. If you're going to get into a home and you've got an air conditioning that goes out, that could be $5,000, $6,000, $7,000 in my market, right? If you've got a roof leak, that could be $1,000, $2,000, $3,000 issue on average. A lot of these little things are going to pop up and you want to be prepared for them. So I'll see a lot of times, the tighter the budget, and it doesn't have to be somebody in that first-time homebuyer range, but it usually is, where they've got whatever it is, pick your number, $12,000, $15,000, and that'll be their full down payment on a home. And they could go a little bit lower, but they choose not to. And then 6 months down the road, they have a little bit of a bind that they're facing. And of course there are options, but man, if you had cash, that'd be the simplest option and a lot of times the cheapest option. So just having a little bit of a reserve, I think, is good for any buddy on a tighter budget who's purchasing a home.
Exactly. And then one of the other things, when we look at financing, there's a lot of different data points that are considered and viewed when we look at underwriting. And one of those is the strength of the buyer in terms of assets in reserves, right? So let's say that you have $85,000, $86,000 in total assets, and you're going to use 80 of that to buy the house. Well, for all intents and purposes, you just depleted your entire asset, all of your reserves to buy this house. That doesn't necessarily weigh favorably with underwriting because you've only got $5,000 or $6,000 left. it makes a lot more sense to put less down to show that you still have reserves. So for something that might come up for a rainy day, underwriting feels a lot better about you being able to continue to make payments.
Yeah, and I want to point out to you guys, if you don't know what underwriting is, Nate is a lender, right? And he's based off commission. He wants to help you get that loan closed. He's incentivized to, which I love. I love that realtors are incentivized too. They have to work to make money. That means they got to work for you, which is what you want. The underwriter is a salaried position. They don't care if you get the loan or don't get the loan, and their job is to protect the bank. So a lot of times the guy in Nate's position, the lender, the one that you're talking with and interacting with throughout the transaction, he's submitting what you're giving him to the underwriter so that that person can make an unbiased decision on whether or not the bank is at risk or not. Just want to point that out.
Yeah, absolutely. That's correct.
So talk about what's coming up here with legislation here soon.
Yeah, so Fannie Mae and Freddie Mac, those are the two largest purchasers of mortgage loans here in the United States. And they issue letters all throughout the year that provide changes to the way that they view things. And one of the things that they have given to us in the form of a loan level pricing adjustment, so that's an LLPA, loan level pricing adjustment, is some factors that are going to change the cost of rates depending on credit score and depending on loan to value. And loan to value is the difference between 100%, which is the sales price, and the amount that you're financing, right? Mm-hmm. So a 10% down payment translates to a 90% loan to value. It's the difference between 100 and 90. That's the 10%. If you're putting 20% down, and this starts May 1st, Joe, you're actually going to be in a less favorable pricing position for the same rates, depending on what your credit is and what that down payment is. They're favoring that you're either going to take mortgage insurance, which is what you get if you put less than 20% down. And I can explain what mortgage insurance is in more detail in just a moment. But they're favoring if you want to take mortgage insurance, or if you're going to shoot past that 20 and go to 25% down. So it's kind of weird how it works. The rates are a little bit lower on either side of that. And then the closer you get to 20, they're actually going to be a tick higher. So whereas before you would put 20% down and you would think, hey, I'm living it up. I've got the best rate. I've got the best credit. Everything's great. You're actually going to pay more for the same rate.
Anybody listening to this who is not aware of this is probably thinking, why the hell would somebody pay more because they're putting more down and they're in a more favorable position? And before you answer that, am I also correct in saying that if you have, I believe it was a 680, but whatever the credit score is, if you have a higher than whatever the credit score is, you're also going to be at a disadvantage fee-wise. But if you're below that, your fees are going to be cut roughly in half. Is that correct?
Yes and no. It depends on a couple different scenarios. So the change to all of this is that they've actually added additional tiers of credit scoring. But prior, the top tier credit scoring was going to be 760 or higher. That was considered top tier. So if I had a 760 or I had a 960, which doesn't exist, by the way, I'm looked at the exact same way. Yeah. Now they've added additional tiers, right? So now it's going to go from 660 to 678. Or maybe I'm saying it wrong, but there's two more tiers. Sure. So basically, top tier now is going to be anything that's 780 or greater.
Okay. I don't know that I'm okay with that. Not that this video is about what I'm okay with, but the challenge I have that I think a lot of other people would have is, why, if I'm putting down more cash and I'm putting myself and honestly the seller, right? Because I'm showing them, hey, I've got the cash to put down. That's a more favorable position for the buyer, and it's a more desired position for the seller. Why would we be put at a disadvantage with added fees or rate changes that are higher?
So I don't know exactly what the logic is, because they're not going to tell us this is their logic. But if I had to make an educated guess with my experience, and I know that the way things work, they're forcing people to either take on that mortgage insurance because it puts them at less risk than if they put the 20% down, because now they've got this mortgage insurance policy in place, or forcing them to put more than 20% down also eliminates some of the risk on them. I think they felt that 20% needed a little bit of a shakeup. So they're forcing you to go one direction or the other with the pricing. So you're either going to take on that mortgage insurance, which eliminates some of the risk that they have, because now you've got this insurance policy to protect them, or you're putting even more money in now to make sure that their risk is even less.
So I've read quite a bit on this, and maybe it's because of where I'm reading, but a lot of what I'm hearing is it's the current government's desire to subsidize housing or housing prices, mortgages, mortgage pricing for people who have lower income, lower credit scores, and they're doing it on the backs of people who have more cash and higher credit scores. And if you know anything about me, man, I'm all about don't ask for it, earn it, right? Yeah, I don't want to be handed anything. I want you to tell me the rules of the game, and I want to go out and kick some butt. I'm not a huge fan. Of course, everybody's going to like the fact that your rates are going to be a little bit better. Your fees are going to be a little bit better if you do have less down and you've got a worse credit score. Awesome, right? Great for you. The challenge I have with it is that people with higher credit scores who take care of themselves, take care of paying their bills on time, pay attention to their bills, are organized, the kind of people a lender would want as a customer, they're going to be put at a disadvantage, not because the lender wants them at a disadvantage, but because the government wants them at a disadvantage. And I'm just not a huge fan of that for our top end buyers at all. I don't think it's fair at all. I think it's crazy, to be honest with you. And not that it matters what I think. It doesn't matter what I think. What matters is just understanding the facts and how to play the game. But I'll tell you the first thing that popped into my mind, and I know this is new, so I don't know that you'll have an answer to this, but my first thought is pick your credit score. I know what you were kind of throwing around credit scores here, but let's just say it's 680, whatever it is, right? And if I've got a 680, I'm going to have a little bit higher rate or maybe a little bit higher fee. But if I've got a 679 or lower, then it improves, right? Why wouldn't I want to rack up some credit card debt or be late on a payment or something to drop my credit score so that improves my fee and or rate situation?
It doesn't necessarily. So if you have all on-time payments and you have low credit card balances and things like that, you're going to get the better rates having a higher credit score. The difference is before, the highest tier you could be at was the 760. You couldn't get any higher. Your credit could be immaculate, but you're getting the same offering that a 760 buyer would have. If I'm late on credit cards, or I've got high credit cards, or I let a car payment go, that's going to kill my score. So you wouldn't want to do that to try to game the system, if you will. And I'll say, Joe, one of the things that you were just talking about, I didn't want to bring the political side into this conversation, but since you kicked the door open, let's go. I don't disagree with you at all. This is a way for the government, who has their hand in Fannie Mae and Freddie Mac. They are private companies, but let's get real. This is a way for them to be able to tax people that are being responsible and to be able to reward people that are being less responsible. That doesn't mean that these people aren't responsible, but everybody has issues here and there. You might miss a payment. You might have something come up. You might have a medical bill that goes into collections, and that causes scores to come down. That causes people to have less money available. So it's the government's way to be able to really get their hands even deeper into, taxing people, if you will, for doing the right thing. But yeah, so you wouldn't want to game the system by messing with your credit, by missing payments, to try to fit yourself into that box, because you're still going to have much better rates with higher credit scores. The difference being now your score has to be even higher to get the better rates, and you have to put either less than 20 or more than 20 down to take advantage of the best rate options.
I want to read, I'm looking at a website. It's Olean, Olean, timesherald.com. This was put out 2 days ago, and the article is entitled Punishing Americans with Good Credit. I just want to read about 5 or 6 sentences here. The New York Post reported this week that Fannie Mae and Freddie Mac are prepared to overhaul the fees built into mortgages issued at private banks. The charges, known as low-level price adjustments, are based on a handful of factors and often absorbed into a buyer's mortgage rate. Under the Biden plan, those with better credit scores would face additional surcharges, while those with substandard or lower credit scores would see fees cut nearly in half. When absorbed into a long-term mortgage rate, the increase is the equivalent of slightly less than a percentage point in mortgage rate, the Post reported in reference to buyers with higher credit rating. On a $400,000 loan, which in Port St. Lucie, that's roughly what the average price is, and a 6% mortgage rate, which is give or take right at where we've been here in the last couple months, that buyer could expect their monthly payment to rise by about $40. That's nearly, if you look at the life of a 30-year loan, that's roughly $15,000 that you could be paying simply because you chose to take care of your credit. Is there anything I'm missing there in understanding that? I see you winced a little bit. What am I missing?
I don't think that you're misunderstanding anything. I think that was written by a food critic who read something on MSNBC, maybe, because it's not entirely accurate.
Tell me what's not accurate.
The higher credit score folks are not going to be penalized. Again, I'm going to just kind of recap what we talked about.
I want to ask one clarifying question. So this has nothing to do with credit score. It has everything to do with the amount that you're putting down as a percentage of the total sales price.
It's both. It's both.
It is both. Okay.
Yes. The higher your credit score, the better your pricing on these things are going to be. But in addition to that, and I can share the chart, I have the chart. I can share it with you in the chat when we're done. I'll post it. The higher the credit score, the better. The more you put down over 20, the better, and the less you put down prior to 20, the better. It's basically between 15 and 25% down. So that 10% bracket, those people are going to have a higher cost for the same rate.
I'm going to share something here, and I might get in trouble for it, but I want to see if this is what you were talking about.
I can send you the link. It's not anything that's secretive. Anybody can Google Fannie Mae. Yeah,
is this it?
Yeah.
Okay.
Yeah, that's it. Yeah.
So talk a little bit about this. Well, is it okay if I read it from a layman's?
Sure.
I'm not that I'm a layman, but I'm not a lender, right? So let me see what I understand of this.
Yeah, go for it. I'll take a drink while you're doing that.
This is how much we're adding on or taking away to whatever the market rates currently are. So in the top left corner, if you've got 70% down, which leaves you 30% financed, and you've got a 780 credit score or better, all the way down to a 660, the rate is the same. It's not going to change. Am I reading that correctly?
Correct.
Okay. But if you get to a 659 or below, they're going to add a half a point on top of whatever the market rate is, as shown in the bottom left two boxes. Is that correct?
Incorrect. The correct number is being used. This is not a hit to the rate. This is a hit to the cost of the rate.
So these are one-time upfront fees, correct?
Right. So when we get a rate from Fannie Mae and Freddie Mac, this is the rate that's offered at no cost. If you want to pay points, you can buy the points. So think of this in terms of these are your points being added. So let's just say today the best rate I can get you, Joe, is going to be 6.5%. But now to get 6.5%, you're going to have to pay half of a point. Do you follow what I'm saying?
Yeah.
That's what you need to see that as. It is not it's not the rate itself. It's the cost of the rate. And this is showing you what the differences are. So this chart also is confusing because if you just look at this chart like the food critic from MSNBC, I agree with what he said, but that's not what this reads. This is showing the changes to the LLPAs. This is not showing you what it is going to be. So this is also partial information.
Man, this is goofy as hell. And I'm going to tell you why. The third column, right? 60 to 70%, that would be financed, which means I've got 30 to 40% down. Yeah. It starts when you get the best credit score of a 780. It says 0.25%, which means you're paying an additional 0.25% upfront and a one-time fee, correct?
That's right.
Okay. And then the next row is another quarter point. The next row is an eighth of a point, 0.125. Then it goes 0%, but then it comes back up if you've got a 7 to a 719. But then if you get to a 680 to a 699, they're giving you a little bit of help. But then if you're a 660 to 679, it goes back up. and then it comes back down at 659 and lower. This chart makes no damn sense. And I can see if you look at below 640, that very bottom line, you can see, and I'm generalizing here because what I'm about to say isn't 100% true. It generally gets better and better, or I should say worse and worse, as your credit score gets worse.
So again, though, these are the
hold on. Except if you're under a 640, then all of a sudden it magically gets better. It gets better for the 30 to 60% financed. It gets better for the 60 to 70. It gets better for the 70 to 75, 75 to 80, the 80, like most of them, right? Why in the hell would we be incentivizing people who can't make payments on time and don't want to organize their finances in a way to position themselves with better credit? That makes no sense to me.
That's the age-old question, Joe. The government doesn't make sense to us.
Yeah. I don't like it. I don't like it as a worker, right?
Sure.
I love that I'm 100% commission. If I don't offer you enough value, you don't like me, I'm not answering your phone calls, I'm not putting you in front of the right homes, I can't market your home well enough and sell it, you can fire me and I make $0. I love it. And you're in the same boat, and I love that.
Yeah, exactly.
I don't like that our good, strong, intelligent, hardworking, organized clients are going to be at a disadvantage because they don't have a horrendous credit score.
But they're also not at an advantage for having a lower credit score. If you look at the actual, again, those were just the differences. That's showing you old to new. This is the difference between the old to the new. If you look at the actual numbers for the new,
that results in,
they don't get incentivized for having lower credit.
Do you have that chart?
I can pull it up on the internet. It's on the internet. You can Google Fannie
I want
Mae.
to tell everybody, Nate asked me right before this, what kind of curveballs are you going to shoot me? And I said, no, man, we're just going to chit chat. No big deal. And now I'm doing it to him.
Fannie Mae LLPA. I mean, you'll see it'll be the
I'm going to look it up. Fannie
everybody can Google this.
May LLPA.
LLPA.com. No, just Google that. Just Google that.
I got you. Let's try this. What's this look like? I'm going to get a virus now, aren't I? Oh, this is what comes up. Okay, I'm going to share a screen here and you can tell me what we're looking at.
Sure.
Boom, boom, boom. That's not what I want you to see. Let's try that again. I want you to see. It's got to be this. Correct?
Let's see. That's it.
Okay. So there are a lot of charts here. Which one am I looking at? There's what, 4?
Start at the top.
This one?
All the way up. No, all the way up. I just want to make sure that's the right one. Yeah, okay. Yep, that's the right one. So yeah, what you are looking at there is the one that
I got you.
May 1st.
This top one
goes into effect May 1st, right? So the top box, that's going to be your LLPA by credit score and LTV ratio. So that's the same thing you were just looking at, but what you were looking at was the hot sheet that was showing what the changes were. If you see, well, you're not going to see that on here because that's something that somebody made to just show you what the differences were. But if you look on here, you'll see that with a 780 credit score all the way across, you're getting a better rate offering than you would get if you went any further down.
No, you're right, dude. And I'll tell you, I've looked at probably 5 or 6 of these articles, and I'm sure it's because they're being politically pitched. Not one of these articles showed this chart. It showed the last chart. But again, I understand the why.
But just to make everybody listening and watching, that chart is only showing the changes.
Correct.
So if you just look at that, you're looking at information that is just a little bit of information.
Yep, that makes complete sense. Now, okay, so I just want to look at the let's say 95% column, because that's where a lot of our first-time home buyers are going to be.
Yeah.
If they're conventional, they're going to be 3 to 5. If they're FHA, they're going to be 3.5. Either way, they're going to fall into that far right column. So you can see, guys, 780 bumps. This is the far right column, bumps your fee up an eighth of a point, 0.125, right?
Exactly.
And then every 20 points, you're looking at roughly another, and maybe exactly, no, exactly is not true. You're looking at roughly another eighth a point. In fact, the only time that is not true is when you're going from a 700 to a 699. Then you're looking at a quarter point difference. But
that's right. That's right.
So for a lot of folks that are concerned about their credit, if you've got whatever your credit score, doesn't matter what it is it worth waiting and improving on it? Well, if you're going to pay an extra eighth of a point, let's talk about a $400,000 loan again. 1 point is $4,000. So a quarter of a point is going to, okay. So an eighth of a point is $500. So if I'm correct in saying that, Nate, every 20 points roughly that you're bumping up in credit score, it's going to save you $500 in fees, correct?
Save you $500 in discount points to get the same rate.
Yes. Okay. So for me, I know a lot of these credits, you can do a lot for free with credit scores.
Yeah.
But there are other places that will charge you a rate and you've got a professional helping you. And they're usually charging you $100, $200, maybe $300 or $400. But I'll see that a lot of these folks, and you've got to talk to the credit repair person, because some of these are really hard, some of these are really easy. Right. But I've seen people go up 40, 60, 80, 100 points, and they'll do it in a handful of months. Yep. And if you could pay $200, $300, $400 and get your credit score to improve that much, and it's going to save you roughly $500 in discount point savings per 20 points, that seems to be like a no-brainer. Would you agree?
Absolutely is. Yeah. It absolutely is. A lot of the, I don't want to say high level, because that's not correct. Many people can benefit from having a conversation with a mortgage broker or mortgage lender and having them look at their credit with them and help them with some pointers on things that they can do quickly. It's the more damaged credit or the more intricate cases that I do refer people to go to a credit specialist, because I do not say that I am a credit specialist. I'm familiar enough with credit that I can give you some pointers and some hints and use some technology that I have at my disposal to help you improve on your scores. But there's going to be some that are just really damaged, that are just really gross, that I don't know the best way to help you. And I'm going to refer you to somebody that can. And to your point, for just a couple $100, maybe over the course of 60 or 90 days, you're going to save yourself a lot of money in points, getting a better rate.
So where are these folks in these articles, and maybe it's BS, where are they getting the, hey, if you've got good credit, you're going to be paying an average of $40 more or $14,000 over the life of a loan? Where are they getting that from?
They're looking at that chart that you pulled up that was only a fraction of the fact. That's all that chart did, was show the difference between the old LLPA that we're living under today and the new LLPA that we're going to be living under.
So they're looking at probably one of those specific boxes, and I'm guessing they're looking at one of the worst or most impacted boxes to get their article written. That makes sense. Yeah. Dude, what you just showed me is incredibly helpful. It's incredibly helpful. It makes a lot of sense. Still not a fan. I would say, is the government subsidizing these changes? Or, well, are these for private loans, or are these for government-backed loans?
So the one that you're looking at there is a conventional loan. That's a conventional loan.
That is okay, so that's a private loan. Am I still sharing my screen? I don't think I am.
No.
Okay, so that's a conventional loan. So if it's a conventional loan, it's forced on a private bank what they've got to charge. Because
those are the rates that we get. So everybody from the Nate Jomaa mortgage team to Billy Bob, Expert Mortgage, we all get the exact same base rates from our investors, from our lenders. Okay, so if I go to Joe Rosen Mortgage,
private lenders,
correct?
Yeah,
right. We all get the same rate. They're not giving anybody exclusive rate.
Yeah, I got you.
The thing that changes is our agreement with them on our pricing. So we have the same base rate, and then there's loan level pricing adjustments. Okay, same term, but it's those things are.
I get all that. My question is, if I understand this correctly,
Yeah.
the government can tell a private lender what they're going to charge, and the private lender doesn't have any choice.
No, because we're selling those loans to Fannie Mae and Freddie Mac. Yeah.
What if they keep the loan? If they keep the loan, can they decide on what they want to charge?
They can. So that's called portfolio loans. And I'll tell you. So a loan servicer is who you make your payment to. Mm-hmm. So if I got a loan with the Nate Jomaa mortgage team, the loan servicer is going to be whoever that lender is that I locked the rate in with. But that lender is selling the paper, the actual mortgage, immediately to Fannie Mae or Freddie Mac. So there's a lot of confusion about that too. Every loan is sold to Fannie Mae and Freddie Mac unless they keep the paper.
Yeah.
That happens so infrequently though.
Keeping of it.
Yeah.
Yep. 100%. And so they are heavily incentivized to the extent that they sell to Fannie Mae and Freddie Mac to follow these guidelines, but they don't have to, correct?
They don't have to, but then they won't buy it. It's not an eligible loan to be bought.
Yeah. And I understand all that. And I understand it's very low odds. I want to make sure I fully understand. Okay.
I want to make sure the listeners fully understand.
No, I get it. Well, you've educated me a lot on this. And honestly, this is something that just popped into my peripheral maybe 3-4 days ago. And there's a lot I'm not a fan of. But again, it doesn't matter if I'm a fan or not. What matters is, do I understand it and can I educate my clients on it?
Right.
And I would say an hour ago, I would have incorrectly educated them. I don't know that it would have negatively impacted them because they would have gotten to the lender anyway and figured it out. But now you've educated me, brother. I appreciate it.
Yeah, of course. Well, there are lenders out there that are going to see that chart and still miseducate people. So
I've seen it already.
I would talk to somebody that knows what they're talking about.
Yeah. Well, I appreciate that. I appreciate that a lot. Guys, if you've got any questions on any of this stuff, and really the big one is, if you're thinking about purchasing in the next 6 months or earlier, and maybe up to 12 months if you're 1099 or you got some weird, financial situation, absolutely reach out to Nate, and he's more than happy to sit down with you and have a discussion. A lot of lenders will just shoot you an application link and say, hey, fill out this application. He'll do that too, if that's what you want. But if you want to have a discussion, which is what I as an analytical want, he'll do that with you. And it's incredibly helpful. And there are a lot of situations. In fact, I'd say more than 50% of the buyers who come in wish that they would have talked to Nate sooner, because what he says could have impacted them in a better way had they called him earlier. So the earlier you call him, the better. He's not going to be upset if you call him 12 months out. I get people all the time, Joe, I don't want to waste your time. I don't want to bother you. I'm not going to buy for a year. I don't care about any of that, and I guarantee Nate doesn't either. What we want to do is set you up for success, and it's not that time-consuming. It's a 15, 20, 25-minute conversation, and now in a year from now, you're going to be better positioned. You're going to love Nate more. You're going to love me more, and really when it comes down to it, you're going to love your whole experience more, and that's what it's all about. So this stuff can be complex. You guys know me. You know that I'm a nerd about all of this stuff. And even this stuff, it's new. It was confusing to me. So it's going to be confusing to you guys, right? That's why we do these videos. So if you've got any questions, man, reach out to Nate. Nate, I appreciate you coming on today, brother.
Yeah, of course. Anytime.
All right, my man. Have a great Friday. And guys, have an even better weekend. Take care.